Iron trades.
Okay, so moving forward, confirmations before entry. So how do we validate what we're seeing, and is it truly an A plus entry and not just a setup that we maybe are emotionally attached to or our internal bias is looking at? What we would do is run through a mental checklist or even write it down and have an actual checklist. Are we trading with the trend or going against it? Are we being contrarian or following the trend? There's nothing wrong with counter trend trades, but they demand precision and quick exits. You have to be agile because if it goes against you, you start losing very quickly. Is our level of interest backed by volume and profile structure? So we want to be triggering trades off value edges or volume voids, not randomly in the middle of balance. Those chop zones are where we just have death by 1,000 cuts, as it's said, where the small loss after small loss after small loss, it just adds up. What are the MACD and the RSI doing? Are they confirming the trade? Are they giving us mixed signals? We want to get alignment across these base indicators. And then most importantly, mentally and psychologically, is this an A plus setup or am I just trading because I feel like I should be trading? And that type of honesty, that type of introspection will save you more capital than you'll win in the short and generally long term. And then we have to watch for our red flags. Are we chasing after a big candle? If the candle on the move has already happened, then it's worth just waiting. Entering without knowing where our stop targets are. Trading in the middle of the day when the volume is dead, i.e. through lunch, and the range is very tight. Every setup that we take should check the boxes that we're looking for validation, and it should avoid these red flag behaviors. Defining stop and target zones. This is very important, and everyone should know these before you're entering a trade. Even before your day starts, you should just know these things. So stop placement is very simple, but it has to be logical. We don't want to just slap on a stop, 5 points away or whatever it happens to be. You want it tucked below or above structure. So, for example, below the last swing low if you're going long, or just above a liquidity wick if you're going short. You make sure the market has to work to stop you out. You don't want it to just be there just as that sort of like, oh, if it gets here, I'll leave. You want the market to have to make you leave. So that said, our stop also needs to respect our own internal risk caps. And the example on the slide right now is, example 500 risk exposure. But it's whatever is appropriate to you as a trader. And that defines how far our entry can be from our stop, which keeps our risk control. Now, on the profit side of things, that also needs to be strategic. And you see some traders who have no real strategic goal. It's just moving a stop up behind profit and they just let it run as long as they can. And that's a valid method if that's part of your strategy. But some solid things to consider if you're not that competent is setting a profit target at prior highs or prior lows, because they generally act like magnets. Setting it at the next volume shelf boundary, so before you get to the volume shelf. Setting it at a clean gap or an imbalance zone. And remembering the golden rule is that if we're risking one, we should be aiming to make at least two. A 1-to-1 risk to reward is a floor. It's not a goal, it's a floor. And if we're consistently taking 2-to-1 risk to reward or better, then we only need to win 40% of our trades to be growing and growing into profit. That's what that risk to reward ratio provides you, is that you have not only stop losses and risk management, but you don't have to win absolutely everything to be profitable because you're targeting more than you're risking. Execution tips and discipline rules. So final slide here. And this is where consistency is built. Execution and mindset. So best practices for execution. Pre-setting your stop and limit orders wherever possible. Don't rely on being fast enough. Use the tools available to you. And understand that as humans who are day trading, we're the least capable version of the market participants. The high frequency volume traders, the institutions, the banks, everyone has better resources, faster tools, higher algorithmic proficiency than a human. So you have to use every tool and every efficiency and every automation available to you You will not be able to out trade computers just with your hands and eyes. Let price come to you. You're a sniper, not a machine gunner. So wait for the setup. Don't just throw it at everything you see. If you're unsure mid-trade, take your partial profits, flatten it manually. You don't have to let everything run to either stop or profit. You can take it when it looks appropriate. And if you're unsure mid-trade, don't let that indecision destroy a setup. Don't let green turn red. If you're halfway to your profit goal, it doesn't look like it's going to make it, walk away, book that profit, and that's a win. So mentally, best practice. Do not take a trade unless every piece of your checklist is checked off. Now, obviously, there are very few that are going to check 100% of boxes every time. And we're not going to pretend that every trader who is successful only does 100% A plus setups. Once you improve competence, execution, methodology, you can start taking things that are a little bit more on the edge of your strategy, things that maybe your tape reading and an instinct take over. But as you learn, as you grow, you should only be looking to take the best version of your trades. Accept that missing trades is part of the game, and this is a big psychological one. There'll always be another setup, and if you just took a loss, you don't immediately need to re-enter to win it back. But if you try and take everything, or you are forlorn when you miss a setup, you start trying to take more and more and more, and the more trades you take, the higher your risk exposure is, the more frequent your risk exposure is, and you don't want to be doing that. Step back, reassess, wait for the best setups. The whole goal is repeatable execution, and the profit comes from hitting the exact same shot over and over and over again, not from trying to call tops or call bottoms. You want to stick to a plan, you want to trade a structure, and you want to try to ignore emotion. And that is the best version of trade entry mechanics.
Iron Trades.